Welcome to my channel. I'm the cover call guy, and if you're an old subscriber, if you've been watching my videos, this is a new update. I will try to be updating my annual, monthly, weekly, and daily at the end of every month. Try to. Right now, my portfolio yields annually $72,761.78. Monthly, $6,063.48. Weekly, just about $1,400, and daily just about $200. Whew, that is a lot. I will probably just say the annual and then let you guys see the monthly, weekly, daily going forward. That's a lot compared to what I was typically saying. But anyways, legal disclaimer before we start this video. This content is for information and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risk, including loss of principal. Please always do your own research and consult a licensed professional before making any financial decisions. I'm just some random idiot you found online, and I could be completely wrong. And I didn't mention, but I changed it just to really show updates, right? And for those who are new to income investing, cover call investing, and those who are just not investing yet but on the edge, and you found my channel, welcome. Um, Investing works, right? You don't necessarily have to go into income or cover call ETF investing, even though this is what this channel is all about. I'm strictly in finance, cover call ETFs, and income investing. That's what I do. That's what this channel is about. But if you're into growth investing too, you're welcome. I try to make educational, informational videos. I try to give my thoughts and opinions on it. And as you can see, I didn't come this far at $72,000 a year by not being consistent. So consistency works. Consistency pays off, and it doesn't matter how much you invest as long as you invest. All right, today's video is going to be about Kurv. I think it's pronounced this way. Kurv Investment Management is my deep dive into the yield premium ecosystem that they offer. My report date for this slide is November 28, 2025. And I'll be uploading on this date. So if you're watching it in a later date, it might be already outdated. So this is the date I've made this slide. So let's get into it. All right, this is my first glimpse. What exactly is Kurv? Again, these are my thoughts of it. Think of Kurv as a pro tools for your portfolio. Normally, complex option strategies like synthetic longs are locked away in hedge funds with $1,000,000 minimums. Kurv's wrap these institutional strategies into a simple ETF ticker you can buy for $20. They do the heavy math for you, so you don't have to, right? The big shift that I found is that in late 2024, they graduated from using a rented trust from NEOS. Yes, I believe it is from the NEOS fund of the great popular SPY and QQI. I could be wrong on that. I think it was from them, right? So they basically worked, or was like a sub branch kind of, like it was under NEOS, but not working with them directly. And then now they have their own ETF. So it just means that they now own the entire kitchen instead of giving them full control over the menu and giving them full control over the menu ingredients, right? So they were basically renting the space from NEOS and kind of working underneath them, kind of. I think that's how I understood it. But now they're on their own. I think as of 2025, I believe the asset under management for this entire fund is 195 million. So they are pretty popular. Anything over 100 million in such a short time, it means they're doing something right. A lot of people are buying it, and hopefully they continue to do well. So corporate profile and leadership. So hopefully the information, right? I try to pull it all of them from the website and from multiple sources to try and kind of fact check myself, right? So right here is just as I said, assets under management is about 195 million. Headquarters in San Francisco, California. Structure is proprietary, which is they own it themselves, and then they have their legal team. Custodian is U.S. Bank, auditor Cohen and Company, distributor Foresight Fund Services in their own trust. Institutional pedigree, right? So Howard Chan is the founder and CEO, former head of an ETF business for PIMCO in Europe, and also held role in Goldman Sachs Assets Management. And then Dominique Cherson, which is the PM, 25 plus years experience, ex-PIMCO portfolio management specializing in overlay strategies. And this is all they own, all 10 ETFs as of November 2025. Again, I could be wrong if you're watching this in a later date. So as of November 28th, 2025, which I mentioned in the first slide, this is all I found. This is what I found on the website. KQQQ, KYLD, KGLD, KSLV, GOOP, which is Google, MSFY, Microsoft, TSLP, Tesla, Amazon, Netflix, Apple. And for the most part, their expense ratio is about 0.99%. They range anywhere from 12% to about 25 to 30%. Right here being Microsoft being the highest. They have QQ as their growth, KYLD as their multi-asset, KGLD and KSLV their commodities, right? Silver and gold. And then they have Google, Microsoft, Tesla, Amazon, Netflix, and Apple as all of their single stocks. And year to date, they are all positive, and that is except for Tesla. I think as of November 2025, they are about down almost 4%. So they have a 90% positive year-to-date returns. So I'm assuming that is why they're very popular. Good job on them. All right, the Harvest Strategy Engine, right? How it works. We always want to know how it works. One, they use synthetic longs. Instead of buying 100 shares of Tesla for $25,000, they use a synthetic contract, long call plus short put, that controls the same 100 shares for a tiny fraction of the cost. This free up massive amount of cash. And then they also have treasury collateral. That free up cash doesn't just sit there, right? 90% of it's parked in ultra safe U.S. Treasury bills, T-bills. This acts as a shock absorber, paying you a steady 4.5% interest on top of everything else. It's like a bond fund inside your stock fund, right? So 4.5% as of now, November. Once those rate cut comes, it could go lower. Out the money overlay, right? This is where the magic happens. While others sell options at the money, instantly capping your gains. Kurv sells them at 5 to 10%, 5 to 15% higher. If the stock rallies 10%, you keep the profit. You only get capped if it goes to the moon. If the market just shoots up crazy, right? Some really good news happens, and something happens in the world, and it's just a good thing for the market, good thing for the U.S. economy, good thing for the global economy. All right, the market is just gonna moon. All right, growth and income, right? These are their two heavy hitters. These are their two, in my opinion, their biggest, most popular ETF, KQQQ. This is their flagship, right? Plus almost 20% year to date with a 17.7% yield. So massive return and massive yield. All right, so what is KQQ? It is pure tech screen, right? The Qs. No Pepsi, no Costco, only growth engine of the NASDAQ 100. They use a dynamic overlay. In bull markets, they leave position uncovered to capture maximum upside. Momentum weighted, overweight stocks with a 2-month and 5-month relative strength. So they are very momentum weighted, so it can swing good to you or down bad for you too. So you gotta have to weigh how you want their strategy to be in your portfolio, because it can drag you up and drag you down. KYLD, it is their weekly payer. It's their weekly paycheck, their weekly distribution funds of funds. I think it's a funds of fund. I have to, if I'm wrong, double check me on that. From what I gathered, it doesn't invest in a mix of securities that include other ETF and closed-end funds. It combines equity investment and option strategies. So I don't know if that counts as a fund of funds or as a regular ETF. That kind of threw me off a little bit. So I'll just go ahead and say funds of funds. If not, then it is an ETF. But there is a huge difference. So correct me if I'm wrong on that, if you guys own this weekly payer. KYLD is a little bit more aggressive, right? Hold gold miners, silver miners, and high beta tech. Lifestyle income, right? Designed specifically for investors who need cash flow every single week. Cost efficient. 1% fee, right, is a bargain for a funds of fund structure. 1%. Anything above like 0.68% is already pretty high. You want to be like 0.68% and lower for these cover call ETFs, but a lot of cover call ETFs are pretty high in terms of expense ratio. All right, precious metal. Why Kurv beats physical? The problem with metal is that investing in physical gold or silver has a major flaw. It pays zero interest. In fact, it costs money to store, right? It's a sterile asset. The physical gold trap collectible tax rate is 28%. The Kurv solution KGLD and KSLV synthetic carry by using derivatives and treasuries. They create a synthetic yield. You get 4.5% treasury interest plus the option premium. It has massive yield, right? The gold has 12.37%. Silver is 23.48%. Because it has a higher volatility equals higher premium. The tax alpha potential for Section 1256 treatment, which is 60% long term and 40% short term rates, avoiding the punitive 28%. Now, of course, the problem with this is it's very preference based, right? So if you're talking to someone like me, I prefer to own the physical. Yes, I'll make no income off it. However, when it comes to precious metals, I have a boomer mentality. Um, Matter of fact, this month I bought a few silver chains and a silver coin. I just like the physical. Why? I like I like a new chain. Sometimes I buy myself a new ring. I mean, I always go for silver or gold. So does it hurt me in the end? Yes and no, right? I mean, at the end of the day, if I really wanted to sell it, I'll sell it. Of course, I would either break even or sell for more. I won't just sell to sell it. But that's just me. This one is a little bit more preference, right? If you want the income, obviously buy the ETF. If you don't really care about the income, buy the physical. All right, yield analysis and insight. We have Microsoft at almost 30%, the silver at almost 24%, Tesla 23%, Netflix 20%, Amazon 20%, KQQ at almost 18%, Google at 13%, and Apple at 12%, right? My take on this is that the Microsoft mystery, why is the steady Microsoft paying almost 28% or paying almost 29%? This suggests that they are aggressively harvesting volatility spikes or issuing special distribution. It's an anomaly to watch closely because with such high yield, we have to figure out where it's coming from. We don't want the NAV to be destroyed, right? So if the NAV is not being destroyed, we have to keep a good close eye on it, especially on these single stocks that correlate with a very strong uptrend market. My silver take, the 11% spread between KSLV and KGLD exists because silver prices whip around violently, right? More volatility equals more expensive options equal bigger paycheck for you. That's the easiest way to look at it. All right, the sweet spot for me for this fund would be 15 to 20%, right? Probably around, like, if you want to look at Amazon or KQQ, right? That would be where I would consider the Goldilocks zone. Enough yield to pay the bills, but not so high that it destroys the fund's value, right? So you can even go for Apple, where it's even like less volatile. And then once you start to get up to around here, it's kind of like, okay, where's that yield coming from? I'm gonna just chill out a little bit, right? But KQQ is kind of like that sweet spot. KQQ and below. Of course, these can kind of change, right, depending on the market and the company itself. Benchmarking the total return difference, right? Philosophy, moneyness, on NAV stability, right? The key insight here is that the most critical distinction is upside capture. YieldMax caps you immediately. If the stock rallies 10%, you get 0% of that growth. Kurv sets the cap at 10% higher. If the stock rallies 10%, you keep the growth and the coupon, right? You don't want to be giving away your discounts. This is why Google is up 54% year to date, while many peers are flat or down or down. When I say Google, I mean GOP, not actual Google. All right, so you can see here, Kurv Invest total return, 5 to 10% out the money. NAV stability is moderate versus YieldMax, which is the philosophy, it's max current yield. Moneyness at the money, 5% out the money. Their NAV stability is high erosion risk, and Defiance is hyper yield daily, in the money puts, very high. And then of course Neos is kind of like that rock, right? The philosophy is data driven income. The moneyness out the money index calls, Their NAV has been very stable, right? It's very high. So kind of like Kurv is kind of like that middle child here. And the middle child typically doesn't get a lot of attention. And that's where you got to pay attention, because those are the ones that are very underrated. Risk assessment, right? We always got to look at the oh shit moments, right? Because we look at all of the good, all of the positive, but we tend to forget about what happens when shit hits the fan. That's what we have to think about. It's all nice seeing the green numbers, but what happens when it starts turning red? And I kind of put a scenario here. All right, the flash crash execution. The synthetic long relies on a perfect math. Long call plus short put. If the market freezes or spreads go wide in a panic, the fund could dislocate from the real stock price, and then it won't get bought. And what happens in a synthetic swap? Well, no one buys it. It becomes worthless. FOMO, right? You get called away, of course. If Google reports about blowout earnings and jumps 20% overnight, you are capped at 15%. You will watch the stock moon without you. That is that's a trade-off with almost all cover call ETFs. That one is a given. I always have to list it, right? If you're new to cover call ETFs, income investing, that is pretty much a trade-off for all cover call ETF, including the great NEOs, right? So every cover call ETFs kind of has that downside. The death spiral. If the fund pays out 20% but only earns 10%, it eats its own tail. Right? The NAV drops, meaning next month, 20% yield is calculated on a smaller base, rinse and repeat until zero. And there are funds that does this. It's been mentioned in this video. So for those who are new, stay away from those type of funds. Black Swan event. Right? TSLP holds no Tesla stock. If Tesla goes bankrupt, or if the clearinghouse, which is OCC, fails, which is very, very unlikely, like a 99% unlikely, right? The synthetic position evaporates. So this is a really, really bad black swan event. I'm not gonna say 99% it won't happen, because a black swan event is something like 2008 market crash, right? Housing crash, the COVID. So stuff like that could happen. That's what we call black swan events. Naked downside. In a recession, the short put creates 100% downside exposure. Treasuries buffer it slightly. If the market drops 50%, this fund drops 45%. And then, of course, the tax surprise. Return on capital sounds great until you sell. It lowers your cost base to zero, turning your eventual sale into a massive tax bill. And, of course, if you're a subscriber to this channel, we try not to sell at all, right? We want to utilize that return on capital. I've made a video about it. You could pretty much defer those taxes until you're deaf and pass it on. So I won't get into it, but I did make a video about it. It's called a step-up basis for those who want to Google and read up on it. I have a personal accountant that helps me with this stuff. So if you want a tax professional, please go, hire an accountant for these specific questions. It shouldn't be too expensive. If anything, it'll be like $75 to $150. I'm sure, if not most, all of you can afford that, right? $75 to $150 in American, if you're in America. Now that might be a lot if you're in a different country, of course. Talking specifically America. All right, my verdict, right? My growth plays will be KQQ and Google. As of right now, these two. These are my must-own for income lovers who fear missing out. They prove they can run with the bulls, but don't bet against them. My pure income play would be the silver and Microsoft, 20 to 28% yields. Right, Microsoft is the sleep well at night. Swan, high yielder, and then my speculative would be KYLD and Tesla, very high octane only. If you want a weekly paycheck or love trading Tesla roller coaster, this is your ticket. Buckle up. All right. Bottom line, I would list this ETF as a core satellite allocation in my portfolio, 5 to 10%. I still want to see them prove themselves. Right now, KQQQ has been pretty solid, so I will keep an eye on that. And of course, the weekly payer, which I'm trying to add another weekly to my portfolio, so I will also keep an eye on that. I have quite a few on my watch list, so at the moment, it will be a core satellite position in my portfolio. And of course, thanks for watching. If you found value in this deep dive, please smash that like button, comment, subscribe, and Disclaimer: this is not financial advice. Please always do your own due diligence. As you know, I've mentioned in the video, I wasn't sure if it was a funds of funds, so fact check me on that. And thanks for watching, guys. Stay tuned. Catch you guys on the next.